Welcome to the Research Desk.
Glad to be here.
So today is Monday, March 16th, 2026, and I want you to imagine generating nearly $140 billion in pure operating cash flow in a single year. I mean, that is more liquidity than the gross domestic product of many sovereign nations.
It's an astronomical amount of cash.
Right, but now imagine having to immediately plow 94% of that cash right back into the ground, into server racks, cooling systems, fulfillment centers, just to maintain your competitive position.
Which is exactly the reality we are analyzing today.
Exactly. We are looking at Amazon. It's an entity currently trading at $211.74 with a market capitalization of $2.27 trillion. And just to put that scale into perspective, Amazon closed fiscal year 2025 generating an incredible $716.9 billion in revenue.
Those numbers are almost hard to comprehend, but they set up the entire debate.
They really do, because the central tension today is a very precise structural question buried within those monumental figures. We have to figure out whether Amazon's staggering $131.8 billion capital expenditure cycle is going to convert into durable, long-term free cash flow.
Right, and this is the bear case, whether this expenditure represents a permanent trap, a relentless infrastructure spending treadmill that will just continually suppress shareholder returns.
Well, I view Amazon right now as a high-probability compounder moving through a perfectly healthy digestion phase. The defining metric of this cycle, for me, is the incredible operational leverage the company has demonstrated. I mean, they expanded their operating margin from a mere 5% in 2022 to 11.2% today.
That is a big jump, I'll admit.
It's massive. This massive Capex commitment is not a symptom of a broken business model. Rather, it is a necessary, highly accretive, high return on investment exercise. They are fortifying their moat for the AI era.
See, I come at it from a completely different angle. Because the financial mechanics underneath the surface, they are flashing severe warning signs of exactly the treadmill you just mentioned.
Warning signs? Where?
When we look at the cash flow statement, the numbers present a pretty stark reality. You mentioned the operating cash flow, that massive $139.5 billion.
Right.
However, that liquidity is being almost entirely devoured by the $131.8 billion in capital expenditures you referenced. What remains is a meager $7.7 billion.
Okay, but...
Hold on, let me finish the thought. We must evaluate Amazon based on its position in the corporate life cycle. It is in stage 4, mature growth. At this mature stage, a cash conversion profile where 94.5% of operating cash flow is consumed by Capex, that is highly problematic.
I think you're overstating the problem.
I don't think I am. When you combine this near-zero free cash flow conversion with a decelerating earnings growth rate of just 5%, the math simply cannot justify the stock trading at a premium 29.49 trailing PE multiple. The market is hesitating right now, and, well, it's doing so for a very good reason.
Let us dissect that hesitation then, because I believe it stems from a fundamental misunderstanding of what happens when a company operates at this unprecedented scale. Let's move to slide 1.
The executive summary and scale paradox.
Right. We are observing a fascinating paradox right now. Amazon is a mega-cap platform sustaining double-digit revenue growth, specifically 12.4% year over year.
Yeah.
But it's simultaneously undergoing a distinct price correction. The stock currently sits 16.6% below its all-time high. Yet, the underlying economics of the business are undeniably accelerating.
Accelerating how exactly?
Consider the $80 billion in operating income generated over the past year. That proves the economic engine is profoundly healthy. When a company posts a $213.4 billion revenue record in a single quarter, like Amazon did in Q4 2025,
Which was a record, yes.
and expands its operating income by 16.6% year over year, the subsequent downward price action is indicative of market hesitation, not a fundamental corporate collapse.
I have to challenge your reliance on operating income here. It obscures the very real difference between accounting and reality.
How so?
Generating $80 billion in operating income is, yes, an impressive operational feat. It is a logistical and computational marvel to process that much commerce and data. But operating income is an accrual accounting metric.
Sure, but it's a standard metric.
But it includes depreciation, it includes stock-based compensation, and critically, it ignores capital expenditures. Operating income does not pay dividends. It does not buy back stock, and it does not fund new business lines. Cash does.
Of course, cash does.
So when a company reaches a $2.27 trillion valuation, the market rightfully demands flawless cash conversion. Revenue scale alone is no longer sufficient to sustain a premium multiple. Investors are looking at the capital intensity required to simply maintain that revenue base, let alone grow it.
I think the market is being short-sighted.
Well, the market is highly rational here. It is questioning whether the structural capital intensity of Amazon's dual mandate, running both the world's largest physical logistics network and a premier digital infrastructure grid, basically precludes it from ever generating the free cash flow margins typical of its mega-cap technology peers.
Well, that dual mandate is exactly why the current investment cycle is so large. To understand why the market is hesitating despite record revenues, we must move to the second slide and examine the clocks.
Right, slide 2.
So look at how the market traditionally prices these massive transitional phases. Right now, on the market clock, Amazon sits at roughly 9 o'clock.
Which places it in a phase 3-4 correction.
Exactly. The stock is 5.8% below its 200-day moving average. Simultaneously, on the corporate clock, it is firmly in stage 4, mature growth. This dual positioning creates cognitive dissonance for investors.
That's a nice way of saying investors are worried.
They're confused by the transition. A highly relevant historical parallel is Microsoft in 2015.
Oh, I knew you were going to bring up Microsoft.
Because it fits perfectly. At that time, Microsoft was reporting its first full year under Satya Nadella. The market viewed the stock as optically expensive because investors were improperly anchoring to legacy Windows licensing economics.
Right.
They completely underestimated the massive margin potential and durability of Azure, which required huge upfront capital to build. We are witnessing the exact same psychological mispricing with Amazon today.
I disagree entirely.
Let me finish. Investors are anchoring to the low-margin, legacy retail economics and penalizing the stock. They are failing to price in the blended margin profile of AWS, AI infrastructure, high-margin cloud services, and what is now a $56 billion advertising business.
That Microsoft 2015 analogy breaks down the moment you look at the physical reality of the two businesses.
How?
Infrastructure is infrastructure.
No, it's not. Microsoft was transitioning from one form of high-margin intellectual property distribution, software licensing via disks and downloads, to another form of high-margin intellectual property distribution, cloud subscriptions.
Right. A transition.
But they were changing the delivery mechanism, not the fundamental physics of their cost base. Amazon, by contrast, is attempting to manage a massively complex, asset-heavy physical logistics network. They employ 1.56 million people, which is their mode.
It's an expensive mode. Microsoft did not have thousands of fulfillment centers, hundreds of cargo aircraft, and fleets of delivery vehicles depreciating on its balance sheet while it built Azure. Amazon is trying to fund the AI cloud transition while wearing a concrete block of physical infrastructure.
I wouldn't call it a concrete block.
It is when you look at the margins. Stage 4 mature growth requires segmented, distinct engines of return. But the immense physical overhead of the retail and fulfillment business makes Amazon uniquely vulnerable to a prolonged phase 3-4 correction. The margin trajectory is entirely different when you are moving atoms alongside bits.
I see why you think the physical infrastructure is a concrete block, but I argue it is the foundation of their most profitable flywheels. This tension between legacy operations and new margin profiles leads directly into our third slide, the Damodaran 4 gravity walls.
The crucial segment. Let's get into the walls.
Exactly. To understand how that physical infrastructure integrates with the digital high-margin businesses, we evaluate the company through this framework. We look at revenue growth, operating margins, capital efficiency, and discount rates.
And the score is mixed.
In this framework, Amazon currently scores 2 green, 2 yellow, and 0 red. Let us start with the first green wall, which is revenue growth. Amazon's 13.6% year-over-year growth at a $717 billion scale is just without peer.
It's large, yes.
Consider Walmart's fiscal 2024 results. Walmart generated approximately $648 billion in revenue, but only managed mid-single-digit growth. Walmart is an apex operator in retail, yet its growth profile is structurally constrained because it lacks Amazon's embedded cloud and advertising flywheels.
Right, because Walmart is purely retail.
Exactly. Amazon is growing twice as fast as the world's largest retailer while maintaining a larger absolute revenue base.
The revenue growth is indeed a green wall, I won't argue that, but context is everything. Selling low-margin retail goods at high velocity inflates the top line rapidly, which kind of distorts the actual quality of that revenue.
I wouldn't say distorts. It's real revenue.
The reason Walmart grows in the mid-single digits is because it operates exclusively in the physical world, whereas Amazon's 13.6% blended growth is heavily subsidized by the digital segments. Which brings us directly to the second green wall you are undoubtedly going to point to: operating margins.
Precisely. And this is the most important change in the entire Amazon investment thesis over the last 3 years.
I know you love this margin story.
Because it's incredible. The gross margin is now 50.3%. The EBITDA margin has reached 23.1%. Most crucially, the operating margin has more than doubled, moving from roughly 5% in 2022 to 11.2% today.
On paper, yes.
It's an extraordinary demonstration of operational leverage. Let me explain exactly how they achieved this, because it was not magic. Following the pandemic, Amazon essentially had a national fulfillment network, where a package might fly from a warehouse in Seattle to a sorting center in Memphis before being delivered in Miami.
It was incredibly inefficient.
Highly inefficient. Under CEO Andy Jassy, they completely re-architected this into 8 distinct regionalized nodes. By keeping inventory local, they stripped out massive amounts of aviation fuel costs, reduced the number of times a package is touched, and accelerated delivery speeds.
Which is great logistics management, sure.
The closest parallel for this magnitude of efficiency gain is Meta Platforms in 2023. After declaring its year of efficiency, Meta drove its operating margin from roughly 25% up to above 34%, and the market re-rated the equity dramatically. Amazon's margin expansion is occurring on a much more complex physical plus digital cost base, making the achievement even more robust.
I am sorry, but I just don't buy that meta comparison.
Why not? Efficiency is efficiency.
Because analyzing the yellow walls exposes exactly why that analogy is flawed. Let us completely unpack the first yellow wall, capital efficiency.
Okay, let's look at the yellow walls.
Meta achieved its year of efficiency largely by reducing headcount and rationalizing digital server deployment. It was a reduction of intellectual capital and digital overhead. Amazon's efficiency narrative must combat physical reality.
But they did combat it with the regionalized nodes.
Returning to the central tension of our analysis, Amazon produced $139.5 billion in operating cash flow, but capital expenditures consumed $131.8 billion of it.
Right.
That leaves just $7.7 billion in free cash flow. We are looking at a 6.9% return on assets. If anyone is listening to this and wondering how a company can generate over $700 billion in revenue and only yield $7.7 billion in discretionary cash, it comes down to maintenance and growth requirements.
Growth being the key word there.
But how can we justify a 94.5% Capex to operating cash flow ratio in a mature Stage 4 business? The operating margin improvements you highlight, the regionalization of the nodes, they are certainly real operational achievements, but the cash is still not reaching the bottom line.
Because it's being reinvested.
It is being buried back into the ground in the form of custom silicon, data center power grids, and logistics hubs just to maintain the growth rate.
I fundamentally disagree that the cash is being buried merely to maintain growth. It is being aggressively deployed to secure absolute dominance in the next computing paradigm.
The AI transition.
Yes. If you want a better comparison than Meta, look at Alphabet. Alphabet faced the exact same pushback in the first quarter of 2024. The market panicked over Alphabet's $12 billion quarterly capital expenditures for AI infrastructure.
I remember that panic.
Right? Investors assumed those expenditures would become a permanent drag on free cash flow. The market sold the stock off, and, well, the market was completely wrong.
In hindsight.
Exactly. Alphabet's aggressive Capex built the necessary compute capacity to scale high-margin AI workloads, which ultimately drove accelerated cloud operating income. Amazon is currently in that identical deployment phase. The $131.8 billion is not maintenance Capex for the retail network. It is aggressive growth Capex funding AWS AI services.
You can't just separate the retail maintenance from the AI growth so cleanly.
We are talking about custom silicon development like the Trainium chips, building the broader data center architecture required to host massive language models like Anthropic's Claude, and securing future power supply. This is a deliberate high ROI moat-building phase.
That argument completely ignores the second yellow wall, discount rates and valuation.
Let's hear it.
Alphabet's core search business required far less physical capital to maintain, allowing them to absorb that AI Capex shark while still generating massive, undeniable free cash flow. Alphabet never saw its free cash flow conversion drop to the low single digits.
True, their physical footprint is smaller.
Exactly. Amazon's yellow walls are much more precarious because of that dual mandate we discussed. We're looking at a stock trading at a 29.49 trailing PE and a 22.67 forward PE, juxtaposed against a meager 5% earnings growth rate.
The earnings growth is temporarily depressed by the investment cycle.
But that valuation implies flawless execution of this AI transition. It assumes the massive capital expenditures will rapidly and seamlessly translate into earnings. But what happens if the depreciation schedule from this $131 billion Capex cycle begins to heavily impact the income statement before the AI enterprise revenue scales proportionally?
That's a big what if.
That 5% earnings growth could easily turn negative. The margin of safety at a 29 times multiple is virtually non-existent when the cash conversion is this impaired.
The valuation only appears constrained if you assume the current Capex intensity is a permanent plateau rather than a cyclical spike. If the fundamental walls are showing a mix of green efficiency and yellow capital strain, let's look at how the mathematics of the chart reflect this on slide 4.
Extreme scan and geometric order.
Right. Let's analyze the extreme scan score of 10 out of 20. This indicates a market sentiment that is highly conflicted. It is neither euphorically overbought nor violently washed out.
It's stuck in the middle.
We saw a nearly identical setup in October 2022. At that time, Amazon was trading roughly 50% below its pandemic high, yet institutional holders maintained their core positions. Sentiment was negative, but professional capital was not panicking. They understood the transition.
But the trend looks weak right now.
The stock subsequently doubled over the next 14 months as the margin improvements materialized. The current technical deceleration we are seeing is temporary, a mathematical reflection of the market digesting this specific capital expenditure cycle.
Well, I interpret the geometric data quite differently. Amazon is currently in geometric order 1, which represents velocity. The precise metrics are highly revealing. For those who follow market kinematics, the sigma distance is negative 1.154.
Right.
The slope is negative 0.000831. The acceleration ratio is negative 1.687, and the jerk is 0.022.
All of which just confirms a pause.
Let me explain what that means in practical terms. Jerk measures the rate of change of acceleration. A positive jerk combined with a negative slope means the speed at which the stock is drifting lower is methodically shifting.
It's just drifting.
The stock is trapped below the $224.73 200-day moving average. A negative slope with deceleration and positive jerk implies a slow, grinding distribution of shares.
Distribution doesn't mean a crash.
Drifting lower is exactly what happens when institutional capital decides to pause allocation. They are waiting for empirical proof of free cash flow before committing further capital. They see the $131.8 billion Capex figure, they see the mere $7.7 billion in free cash flow, and they are stepping back, allowing the price to drift until the financial statements prove the cash flow treadmill is not permanent.
To judge whether Amazon can break this negative geometric trend, we have to look at how they have historically navigated these exact exhaustion points. Let's move to slide 5, narrative cycle history.
Fine. Let's look at history.
Amazon's corporate history is defined by its ability to invest heavily during periods of deep skepticism and emerge with an entirely new, dominant business model. We can break this into 5 distinct narrative cycles.
Walking sequentially through the 5 cycles.
Yes. Cycle 1, spanning from the IPO in 1997 to 2001, is the foundational mythos of the company. The stock fell an extraordinary 94% during the dot-com crash, hitting a low of roughly $5.51 in September 2001.
A painful period.
Extremely. But that drawdown washed out the retail tourist capital and forced the company into a rigorous discipline that birthed the modern e-commerce marketplace.
Cycle 1 is indeed critical, but not for the reason you suggest.
Oh.
It perfectly illustrates the ultimate danger of narrative overextension. In 1999, the market priced Amazon based on infinite total addressable market assumptions, completely ignoring the massive capital requirements of building physical distribution centers. They assumed revenue would equal profit.
Which was a mistake of the era.
Right. When the capital promises failed to meet the cash flow realities, the market repriced the equity by 94%. Yes, they survived, but the permanent lesson of Cycle 1 is that when capital intensity scales faster than free cash flow, the multiple compresses violently. That 94% drawdown was the market realizing that physical retail at scale is brutally expensive.
The subsequent cycles prove the value of building that expensive infrastructure before the market demands it, though.
If you can survive the drawdown.
Cycle 2, from 2001 to 2008, saw the launch of Prime in February 2005. That fundamentally altered consumer behavior forever, even though the stock still suffered a 60% drawdown during the global financial crisis. Cycle 3, from 2008 to 2015, was the stealth emergence of AWS.
That was a brilliant move. I won't deny it.
They built the cloud while the market thought they were just an online bookstore. This culminated in April 2015 when they finally broke out AWS financials, revealing $1.57 billion in quarterly revenue and $265 million in operating income.
A huge pivot point.
Then Cycle 4, from 2015 to 2022, established Amazon as the default infrastructure layer for both digital and physical commerce, supercharged by the pandemic. Obviously, that led to a rate shock and a logistical overbuild that drove a 56% drawdown.
And that logistical overbuild at the end of Cycle 4 is exactly what we need to focus on right now.
We are focusing on it.
They doubled their physical fulfillment network in just 2 years. They vastly misjudged post-pandemic demand, built warehouses they did not need, and completely created their operating margins. Which brings us to Cycle 5, from 2022 to the present.
5 is Andy Jassy's efficiency and infrastructure era, and it is the crux of the bull thesis. Jassy took the company from that bloated, post-COVID logistics footprint where operating margins had compressed to a painful 5%, and ruthlessly streamlined it.
True, the cuts were deep.
He executed the regionalization model we discussed earlier. The result is an 11.2% operating margin and an AI and cloud powerhouse that drove the stock to a new all-time high of $254 in November 2025.
But look where we are now.
This execution is as dramatic and successful a parallel to their Cycle 2 survival as one could imagine. The current correction back toward $211 is just a pause in a massive, multi-year structural margin expansion story. They have proven they can optimize physical reality.
I submit that Cycle 5 is currently repeating the exact hubris of Cycle 4.
How so? The margins improved.
In Cycle 4, they built too much physical infrastructure ahead of demand, destroying free cash flow. Today in Cycle 5, they are building too much AI and digital infrastructure ahead of demand, destroying free cash flow.
It's not destroying it, it's an investment.
The specific medium of the infrastructure has changed from concrete fulfillment centers to silicon data centers, but the financial mechanism of capital destruction is identical. They are assuming a linear adoption curve for enterprise AI that justifies $131.8 billion in spending.
AI adoption isn't going to slow down.
But what if that demand curve flattens? What if enterprise software budgets cannot absorb all this new AI compute? They will be left with rapidly depreciating hardware and constrained margins, just as they were left with empty warehouses in 2022.
If Cycle 5 depends entirely on these new infrastructure investments paying off, we must evaluate the specific forces acting on the stock right now. Let's examine Slide 6. catalysts, and the moat stack.
Let's weigh the bull and bear cases.
The bullish catalysts are structural and compounding. First, we have the AWS AI services layer. The integration of Amazon Bedrock, the proprietary chips, and the massive Anthropic partnership positions AWS not just as a storage provider, but as the foundational compute layer for generative AI.
AWS is strong, yes.
Second, the margin expansion from 5% to 11.2% is not finished. As the higher margin AWS and advertising segments grow as a percentage of total revenue, the consolidated margin will naturally drift higher.
Assuming the Capex doesn't weight it down.
Third, let's talk about the mechanics of the advertising business. It is now running above a $56 billion annualized rate. Advertising on Amazon is not like advertising on a social media feed where the user is looking at photos of their friends.
It's closer to point of sale.
It is pure commercial intent. A user searches for a product, clicks a sponsored listing, and buys it. That advertising revenue operates with software-like gross margins. Fourth, the absolute switching costs and behavioral stickiness of over 200 million Prime members creates a baseline of recurring revenue that funds the entire ecosystem.
That Prime revenue is certainly a moat.
Finally, Project Kuiper provides long-duration optionality for global broadband dominance.
That is an incredibly optimistic catalog of assets, I will give you that. But the bearish catalysts represent acute, immediate threats to the operating model.
Let's hear the bears.
$8 billion Capex burden, yielding only $7.7 billion in free cash flow. It creates extreme vulnerability.
We've covered the Capex. What else?
Second, the retail competition from Chinese ultra-fast fashion and discount platforms like Temu and Shein represents a massive deflationary force on Amazon's core retail margins. Amazon is being forced to lower seller fees on cheap apparel to compete, directly impacting the profitability of the e-commerce segment.
I think that threat is overstated.
It's really not. Third, relentless antitrust and regulatory scrutiny across global jurisdictions threatens to forcibly decouple their integrated business models. Fourth, maintaining a workforce of 1.56 million employees in an environment of persistent wage inflation places an immense, recurring pressure on the physical operating costs.
Wage inflation is a factor for everyone.
Yes, but not everyone employs 1.5 million people. And fifth, the earnings growth deceleration to 5% suggests the operational leverage you tout is already stalling against these combined headwinds.
Wait, unpack that retail competition point. I am not convinced by that line of reasoning.
Why not? Temu is spending billions on marketing.
Because the high margin growth vectors entirely neutralize the physical retail margin pressure. The Chinese e-commerce platforms like Temu and Shein compete at the absolute bottom of the value chain.
But they are taking market share.
They do not possess the logistical capability for same-day or next-day delivery. They are shipping goods slowly across the ocean. They do not offer a broader ecosystem of video, music, and cloud services.
True, they don't have Prime.
The $56 billion advertising revenue alone provides more than enough margin subsidy to absorb wage inflation in the physical fulfillment network. The market continually misprices Amazon by treating it as a traditional retailer fighting a price war over cheap apparel, when in reality, it is a high-margin data and advertising broker monetizing the world's most robust digital marketplace.
That subsidy argument works beautifully on a spreadsheet until the capital expenditure requirements of the digital side overwhelm the cash generation of the entire system.
It's not overwhelming it, it's managing it.
When you are concurrently spending $131 billion on AI servers. Having weighed the operational catalysts against the fundamental walls, we arrive at our final slide.
Slide 7. Position sizing, risk management, and the reclaim.
Exactly. So according to the framework, exactly 4 out of the 6 required buy conditions are met.
Let's break them down.
The Damodaran walls are not met, as we only have 2 green walls instead of the required 3. The market clock is only a partial match.
But the others are met.
Yes. The corporate stage is met, the geometric order is met, the position weight is met, and the trend signal is met, having opened today, March 16, 2026.
Given those metrics, the verdict of cautious accumulation is entirely justified. 4 out of 6 conditions being met is the exact sweet spot for initiating a 2 to 3% starter position.
A starter position?
With the trend decelerating,
If you wait for all 6 conditions to trigger perfectly, you will miss the entire re-rating of the equity. The business is fundamentally stronger than the current technical chart suggests. The decisive technical trigger will be reclaiming the 200-day moving average near $225.
reclaiming that level would be significant, yes.
Reclaiming that level will signal that institutional capital has fully digested the massive Capex cycle, accepted the necessity of the AI infrastructure build-out, and is now pricing in the continuation of the margin expansion from 11.2% toward 15%. Initiating a position here with a plan to add above $225 reclaim aligns perfectly with the reality that Amazon is a high-quality compounder temporarily mispriced by short-term cash flow concerns.
That strategy feels highly precarious. Adding before the $225 reclaim is taken on unnecessary risk while the geometric trend is actively decelerating. It's catching a falling knife.
It's a calculated starter position.
We must respect the downside risk management parameters. The immediate downside zone targets $185 to $190, which is a significant drop from the current $211. Hard invalidation of the entire thesis sits at $160, representing the 52-week low area.
160 is a long way down.
It is. Until the free cash flow profile demonstrates a structural improvement, the thesis remains highly vulnerable. The lack of 3 green walls is not a minor technicality. It is a fundamental red flag regarding capital efficiency.
But if AWS accelerates,
If that $131.8 billion Capex does not yield accelerated revenue growth in AWS within the next 2 quarters, the earnings growth rate will compress further. The 29 times multiple will collapse, and the stock will easily test that $185 zone.
okay, to synthesize our positions, I think we clearly agree on some things. We agree that Amazon's execution under Andy Jassy to expand operational margins from 5% to 11.2% is an incredible operational feat.
Without a doubt.
The cost discipline imposed on the fulfillment network through regionalization after the pandemic overbuild really demonstrates management's capacity to optimize physical assets at an unprecedented scale.
I concede the logistics optimization was impressive.
However, our fundamental disagreement remains centered on the deployment of capital in the current cycle. I view the $131.8 billion capital expenditure as an unassailable, forward-looking moat being constructed around their AI and cloud infrastructure. It's an investment that will compound revenue and drive the next decade of margin expansion.
And I view that exact same $131.8 billion expenditure as a dangerous cash flow trap. It's a capital-intensive treadmill that leaves only $7.7 billion in free cash flow and threatens to suffocate shareholder returns if the AI adoption curve fails to steepen aggressively.
Well, the true test of these competing realities will be the stock's interaction with the $225 moving average in the coming weeks. The market will soon render its verdict on whether the AI infrastructure build-out justifies the current premium multiple or if the sheer gravity of their capital intensity demands a lower valuation.
This is the Research Desk officially signing off.